Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, November 7th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It is a beautiful day here in Colorado. It is no clouds, blue skies, 60 to 70 degrees-ish. And, granted, the sun's pretty low already because it's almost 2:30. But, the sun will go behind the mountain in about an hour, so it'll get chilly then. Anyways, all right. Well, if it is your first time watching Liberty Call, I'm glad you are here. If you could do me a favor, yes, you in the purple shirt, could you give me some thumbs up, a like, a share, a subscribe, a follow, hit the notification bell, because you want to know when I say something smart. It's occasional. It's not every day. But anyways, all right. Well, let's go ahead and get into the numbers for today. Let's go ahead and jump into that. All right. Dow Jones was up 0.17%, 56 points. Closed at 34,152. S&P 500 was up 0.28%, closed at 4378. NASDAQ up 0.9%, closed at 13,639. The VIX was down 0.54% today. It's currently at 1481. Canada was down 0.85. Brazil was up 0.71, and Mexico was down 0.9%. Western Europe, Germany was up 0.11. The UK was down 0.1%. France was down 0.38. The Netherlands up 0.05, Spain down 0.06, Italy down 0.69, Switzerland down 0.05, and Portugal down 2.54%. Wow, pretty big jump for them. Russian exchange is both green. MOEX up 0.35, RTSI up 0.31, and lots of red in the overnights. The Nikkei in Japan was down 1.37, Australia down 0.29. In China, the Shanghai was down 0.04, the Shenzhen Component down 0.15, China A50 down 0.2%, DJ Shanghai down 0.07, Hang Seng down 1.7%, and Taiwan weighted was closed. All right, so kind of a mixed day. Asian markets all red, European markets kind of mixed, and here domestically, it was kind of back and forth. It was in the red, it was in the green, back and forth. Kind of curious to see where things are headed. We've had a bit of a rally since the Fed meeting last week, so I'm kind of unsure why. I mean, nothing has really changed other than they said they may or they may not raise rates in December. Maybe not. So nothing too clear. But they've been pretty clear about holding rates where they're at. So if people think that rates are going to start dropping like a stone back down to zero, I got a bridge. It's over in Arizona. I can sell it to you. All righty. Let's see here. All right, let's get to the market recap. U.S. stocks longest win streak in 2 years as tech stocks shine. All right, U.S. stocks saw gains with technology stocks leading the way. This surge has put the stock market on track for its longest winning streak since 2021, even as concerns about potential Federal Reserve interest rate hikes persist. Despite doubts surrounding the Federal Reserve stance on rate hikes, Treasury yields decreased. This move followed remarks from various Fed officials suggesting the possibility of further rate increases. Fed Governor Michelle Bowman expressed her belief that additional rate hikes are necessary to bring down inflation to the 2% target. They've been saying that for a while. All eyes are now on Fed Chair Jerome Powell, who is set to deliver a speech in the coming days. The futures market is currently anticipating that the Fed will maintain its rates at the December meeting. The drop in Treasury yields had a positive impact on tech stocks, with companies like Apple, Microsoft, Alphabet, and Meta seeing their stock prices rise more than 1%. In other financial news, Uber Technologies reported weaker than expected quarterly earnings, but this was offset by stronger than expected gross bookings, leading to a 1% increase in their stock price. Datadog Inc. experienced a significant surge of 29% following improved annual guidance and better than expected third quarter results. On the downside, WeWork, a workspace provider once valued at $47 billion, filed for bankruptcy due to challenges stemming from reduced office occupancy and expensive leases in a post-pandemic era. Their shares were halted as a result. Lastly, oil prices plummeted to over 2-month lows due to disappointing trade data from China, which raised concerns about sluggish demand in the world's largest oil importer. Weak Chinese exports and a surprising rise in imports contributed to a trade surplus decline, potentially impacting future oil demand. Additionally, the expectation that the Israel-Hamas conflict would not disrupt oil supply in the region has led to a drop in oil prices over the past week. All right, so everyone thought that the Middle East crap was going to create more of an, supply problems or whatever, but that hasn't occurred. So we shall see. All right, next up, some trade data. U.S. trade gap widens more than expected in September. It had been improving over the last couple of months. The U.S. trade deficit expanded. Bless you, Jake. U.S. trade deficit expanded more than anticipated in September, diminishing the likelihood that trade would contribute positively to third quarter economic growth. The Commerce Department reported a 4.9% increase in the trade deficit, reaching $61.5 billion, compared to a slightly revised $58.7 billion in August, which was the lowest level since September of 20. Economists surveyed by Reuters had expected a reduction in the trade deficit to $59.9 billion for September. In the same month, exports of goods and services increased by 2.2% to reach $261.1 billion, with goods exports rising by 3.1% to $176.7 billion. Services exports reached a record high of $84.4 billion. On the import side, goods and services imports also rose, increasing by 2.7% to $322.7 billion. Goods imports rose by 2.7% to $263.0 billion, while services imports increased by 2.6% to $59.6 billion. Despite these trade dynamics, the services surplus saw a slight decrease to $24.8 billion from a revised $25.9 billion. In the preliminary reading for the third quarter gross domestic product reported the previous month, trade played a minor role in the period's substantial 4.9% annualized growth rate. So it's was better, now it's worse. So, I mean, granted, the trade deficit has been in the red basically my whole life, and I'll be 50 in February. So, all right, last up, credit card debt. That is not a good sign. It is going up. Credit card debt grinds to a halt as average APR hits new record high. Alrighty. The Federal Reserve has released its latest consumer credit data, revealing a notable shift in the state of U.S. household debt for September. Total consumer debt increased by a modest $9.1 billion during the month, showing an improvement from August's decrease of $15.8 billion. However, this figure fell short of consensus estimates, which had predicted $9.5 billion increase. This data marks a clear slowdown from previous months, where debt increases were in the range of 20 to 30 billion. Breaking down the composition of consumer credit, both revolving and non-revolving credit exhibited weakness. Credit card debt, a component of revolving credit, increased by just $3.1 billion in September. This is the lowest monthly rise since the height of the COVID-19 crisis, except for an anomalous negative print in June. Non-revolving credit, which includes student and auto loans, also experienced a slowdown. In September, only $5.9 billion in total non-revolving loans were issued, one of the smallest increases since the pandemic began. With non-revolving credit, student loans contracted by a record $27.8 billion, reflecting recent incentives for student loan forgiveness and other government interventions. Great. I love paying off other people's debt. However, auto loans increased by $14.2 billion, a sign that consumers are still taking on debt for vehicle purchases despite rising interest rates. The deceleration in consumer debt, particularly credit card debt, can be particularly attributed to soaring interest rates. The Fed reported that in September, the average rate on credit cards at U.S. financial institutions had reached a record of 22.77%. This has made consumers more hesitant to use their credit cards, especially as the personal savings rate has dropped from over 5% to 3.4%, its lowest level since 2022. As consumers pull back on spending due to high interest rates and increased debt burdens, there are concerns about potential impact on the U.S. GDP. With consumer purchases traditionally playing a significant role in the U.S. economy, a slowdown in this sector could lead to negative GDP growth in the future. Oh my God, wouldn't that be terrible if people couldn't rack up debt and just buy stuff they don't need? Anyways, yeah, watch those delinquencies. Pay attention to that stuff in the financial pages, because as so goes the collections departments, so goes the economy. And I spent nearly a decade on the collections and recovery side of the financial world in my first, 8 or 9 years in the financial services industry after getting out of the Navy. And you could pretty much tell, based upon the delinquency rates in the, I worked for Citibank, started out there. And, you could see as the queues grew, it also kind of would tell you what was happening in the economy. So, I mean, if normally you had, I don't know, I'm just throwing out a round number of, say, $30 million go from current to 1 month late, if that was the average, if, it's been climbing up and now it's like, say, $35 million goes delinquent that month, or the next month. It kind of tells you, you can see those growing through time, and it kind of gives you a clue of how the economy is going. At the time, I was in my 20s. I really didn't care about that stuff, so it didn't really matter to me. But anyways, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.